All right, everyone, we're back. Today we're going to talk about an exciting subject. You've now done well on your investment. It's time to sell, reap the benefits, but there's critical decisions to make still. So today we're going to talk about 5 ways you can save money when you're selling a property. So let's get started. Okay, now this might sound a little crazy, but the first option is actually pay the tax. I know, you're thinking, well, aren't you trying to tell me how I should save money? Well, actually, you can potentially do very well with this option. It just depends on the circumstances. Also, a lot of times it gives you flexibility that you may not have on the other ones that we're going to go through. So let's talk this through before we just completely throw it out. So just in general, how the gain is taxed when you sell property is it's the difference between whatever you sell it for, less your selling costs, and then less whatever your adjusted basis in the property is. In other words, adjusted basis being what you paid, less any depreciation deductions you taken, plus any improvements that you may have made to the property that had to be capitalized into that project. And we'll go into more detail on how to calculate the gain on the sale of a property so that you have a better idea. So make sure to check out that video if you're unsure. Now, once you know what your gain is on the property, now it's, well, what is the tax rate? Most of the time, if it's a rental property and you've held it for more than 1 year, it's going to be at the capital gains rate. So that's anywhere from 0 to 20% under current law. Of course, that could change at any moment. So make sure you keep, your eyes peeled on changes, especially now with the new Biden administration. Or if you have held it for less than a year, or it's property that's held as more of an inventory type item, like for example, if you're a flipper, then it's going to be taxed at your ordinary rates. So that right now, the highest rate, 37%. Of course, if you're in the lower brackets, it could be taxed at a lower rate, but generally it's going to be higher than whatever capital gains rate you would be subjected to. Why I say this is potentially a good option is, one, if you're paying capital gains, you're potentially paying half the rate as your other income. So it could be a good idea if you're choosing what type of income to pay tax on. So a lot of times you may have the option, depending on timing, to either pay tax on one type of income versus another. And so if you can't zero it out completely, maybe better recognizing the capital gain income instead of the ordinary gain income. So that's one reason. The other reason is, a lot of times, and this is incredibly common with a lot of the real estate investors and professionals that I work with, is they have multiple investments, which means that they may have losses over on one property because they've done a cost segregation study or other depreciation, or maybe they've done a lot of improvements that we were able to expense. And so if we know that those deductions are going to happen in the same year that we're selling a property, we may be able to time the sale such that those losses can offset it. So when I say pay the tax, it may actually be sheltered. And so you would be better off sheltering it, having maximum flexibility to do what you want with that cash, versus trying to fit yourself into one of these other options and being subject to a lot of limitations some of the time. So that's one of the other reasons that I say paying the tax is an option. The next potential tax saving opportunity is 1031 exchanges. So a lot of you have probably heard about these. And this is a great option because it allows you to defer the tax. Now notice I didn't say exclude. Those are two different things. Deferral of the tax essentially means the tax is going to be due at some point. You just don't have to pay it today. And as we all know, $1 in our pocket today is worth more than $1 in our pocket tomorrow. So the idea of an exchange is to keep as much of those tax dollars in your pocket today so that you can invest. You would then later pay the tax and you'd have a lot more in your pocket at the end of the day. So 1031, we've done a video on this, so be sure to check it out. We go into more detail, but just a quick overview of some of it. In a 1031 exchange, the idea is that you sell a property and you identify a new replacement property to then put that equity into. And if you do it successfully, You won't pay any tax at the time of the sale. All of that will carry into the next property. You can move forward and you can keep doing this over and over without paying tax. A third potential option to save tax on the sale is what's referred to as qualified opportunity zones. And this is a relatively new tax benefit. This was part of the new tax law that was passed and began in 2018. You might have heard of it. And we have another video on this as well. There's tons of little nuances and compliance with this, but if the gains are big enough and the investment is good enough, then this can be a really great opportunity. In fact, a lot of times it can actually trump a 1031 exchange. And so essentially what a qualified opportunity zone is this designated areas where essentially the government's wanted to incentivize investment. When you make an investment in an opportunity zone, whatever appreciation you have in that investment, if it's held for at least 10 years, it's permanently forgiven. So let's kind of talk that through for a second. Let's say you had one property, you sold it, you had $100,000 in gain. You take that $100,000, you place it into an opportunity zone, you hold it for 10 years, and let's just say you've done a lot of improvements, you bought a larger property, you'd taken on debt, it was leveraged well and performed well over 10 years, and now your $100,000 investment is worth $1 million. Well, when you sell that property, that difference between $1 million and your $100,000 investment, $900,000 permanently forgiven. Never pay tax on it. That's beautiful. You cannot do that with a 1031 exchange. So of course, don't go do this on your own. Have your CPA help you. If they don't know about these, make sure you find one that's done a lot of work in them. It's a very specialized area. Okay, the fourth option we're going to talk about is installment sales. So I don't know if you've heard of these before, but essentially what they are is when you're taking payments for the property over time. You don't receive it all up front. So a common name for this also in the real estate world would be a seller carryback. So this would be, for example, if you have a property, you want to sell it to someone, and say you sell it for $100,000 and they say, well, I can't come up with bank financing, I don't have $100,000 in cash, and you decide, well, I'd like to take some payments over time anyway. Maybe it'll be a nice retirement, I'll get some interest income. So why don't you just give me $20,000 now, day we close, I'll take a note back for the $80,000 and you make payments over whatever time period we determine and at the interest rate that we determine. That would be considered an installment sale. And the benefit of this, other than the non-tax benefit of generating potentially some passive income, would be that you get to spread out that gain over time. So essentially what the IRS says is, well, okay, yeah, you sold this property and you had a gain, but we recognize that you didn't receive all the cash. Maybe you don't have the dollars to pay the tax bill. So we're gonna let you spread it out in the same proportion that you receive payments every year. So that's a great move to defer tax over some period of time. It can also be a great planning tool if you know that your income this year is gonna look drastically different than it will next year or some future year, that you can maybe push income into where you have other deductions, or maybe you don't have income from the other sources that are bumping you up into higher brackets. Now the fifth and final thing I want to talk about, it's kind of complex. I'm not going to get into a lot of detail, but I've had a lot of people ask me about these before, so I wanted to mention it as an option. And these are deferred sales trust, not to be confused with Delaware statutory trust. They both have DST in them, so if you Google DST, you may get both of these coming up. So there's a big distinction between them. But essentially what a deferred sales trust is it's kind of like an installment sale, except in a way you're selling to yourself. For example, let's say you've got a buyer but they want to do all cash or they've got their own financing. Well, and you want to push income into some future year, or you haven't found an investment yet that you can replace with those dollars, you might set up this deferred sales trust, which is essentially a separate entity. It's a trust with its own trustee and everything. It has an agreement. You do a purchase agreement between the trust where you sell to the trust, but on a note. So you don't take the money individually, and the trust will simultaneously sell to the third party. So the trust gets the cash, you don't, you get a note from the trust, and that creates an installment sale if this trust, is actually treated as a separate entity from you. So there are some restrictions, it's not exactly you, but it's essentially you. And so then that gives you the opportunity to then time your income recognition for what's appropriate for you. Now, I would say that you don't want to try doing this for smaller dollar amounts. I mean, obviously there's legal costs, there's more compliance, a little more complications, paperwork, administrative stuff. No one likes administrative stuff. So if the gains aren't big enough, just throw it out. But if you have something big enough and this makes sense, this can be a great option for people. Those are the 5 ways that you could save tax when you're selling property. And be sure to check out our other videos. We'll go into more detail on a lot of these topics, and we'll see you next time.